All right, so many changes are coming to Nigeria's stock market. We have the T+2, that's the trade day and 2 days clearance for trade. And we also have the exchange mulling 5 p.m. close for the market. I hope we're all ready for what's coming in these markets. I guess with new technology coming up at this time, we also have to see changes when it comes to how we trade stocks in Nigeria. Waiting to hear more from the NGX on all of that. All right, let's get to our first conversation now. As global central bankers set the tone for monetary policy, balancing inflation risk with the need to support growth, Nigeria is once again at a key decision point. Central Bank's Monetary Policy Committee, they begin their meeting today. Tomorrow we get a decision. I will cover that live here on Channels Television. Markets will be watching closely to see whether it will stay the course on tight monetary policy or take a more accommodative stance against the backdrop of inflation that's trending downward, currency stability and growth not at where we want it. What choices lie ahead for Nigeria's economy and how might global shifts in rates shape those decisions? Joining us now for the conversation, we have Professor Joseph Nnanna, as a Chief Economist, Development Bank of Nigeria. Join me from Abuja studios. Great to have you, sir. Good morning.
Hey, how are you doing today?
Fantastic. It's been a while. Great to see you again. And definitely we have talked about a lot of decisions, coming out from Nigeria's MPC. But there's so much happening ever since, President Trump's presidency. We've seen a lot of changes in the global space. But let's start with the global context now. How did the recent rate decisions by the U.S. Fed, ECB, and other central bankers, how does that influence Nigeria's policy, monetary policy options, that we're trying to make between today and tomorrow?
Thanks for the question, Laddie. The rate cut played out, in the U.S., for instance, now has a role to play in how the, if you like, overall lending rates globally takes form. That is also what we consider exogenous variables coming from outside the economy and filtering into the Nigerian economy. Notwithstanding, the bottom line here is, if you take a look at what's played out in the Nigerian economy with the relative cooling of inflation, according to the NBS, you also take a look at the relative calm and in the exchange rate. So in other words, we have a stability in the exchange rate market right now, albeit still sticky, but it's stable. And you also see a lot of, if you will, activities playing out in the economy. Whether it's enough, that's yet to be seen. But as it is today, I would say, by and large, there are a lot of exogenous as well as endogenous variables playing out, which the MPC will have to have a detailed conversation about to holistically capture everything together before taking a position on whether to, if you like, reduce rates or cut or hold, as it were.
The decision to make there, if we see the inflation trend for most of the August that we've been through, we've seen 2020, the inflation rate was about 13%, 2021 about 17%, 2022 21%, 2023 26%, 2024 32%, 2025 we're at 20.12%. So we've seen that downward trend since the rebased data from the NBS. But do you think Nigeria's MPC should prioritize aligning with global easing trends or focus more narrowly on domestic challenges?
That's a fantastic question, and I think you hit the nail on the head. So when we take a look at what has played out in the Nigerian economy, the NBS did a statistical rebasing, driving inflation down from around 33% thereabout to now what it is today. And that's a lot of kudos, if you will, to the central bank and the MPC for hiking up rates as they did where it is today at 27.5. But to be sure, I think it's important to take both international or exogenous variables as well as domestic or endogenous variables into consideration. Nigeria doesn't operate in a silo, and if you take a look at our reserves, the reserve balance has grown, and this is largely due to foreign portfolio investors. So if you see the FPIs coming in, and the attraction, if you like, is attributed to the interest rates or the returns in which these FPIs can take away, then the appropriate thing to do would be to actually take a look at broadly what other variables are playing out in the Nigerian economy. Take, for example, on the fiscal side, when you dimension monetary and fiscal policy, we've always argued it must be coordinated, hand in glove. The reality here is, if you take a look at what's played out in FAC allocation, FAC allocation has risen to 2.2 trillion naira on a monthly basis. I think that's the last reading we observed. And that to me spells telltale signs, probably liquidity overhang a bit. And because it translates to, if that much liquidity has been pumped out, banks will pump out liquidity through loans and so on, albeit at a higher interest rate because of the interest rate environment we find ourselves. So, in short, I would say the level of productivity should and must be much higher in the economy. That way we can see more jobs being created and so on and so forth, industries emerging and so on. But the reality is that we've seen currently right now, according to the NBS, GDP is around 3.4%, thereabout. And I say, if the MPC do nothing, my suspicion is that the GDP will still remain around 3%, around 3.5% for the year. The spirit or the notion, when analysts suggest, I've seen this in many reports, economists, analysts, pundits, they all say, oh, it's high time to cut rate, just a signal to the market to reduce rates to make it easier for businesses to now go out and borrow more money, at creating aggregate demand. All that, to be sure, is quite important. But in the end, I would say this. If one is not careful, you run the risk of exacerbating the problem in which you're trying to cure by cutting rates too soon. And I say this because that in itself continues to spur liquidity overhang or excess liquidity or money supply, if you like.
All right, so, looking at the inflation trend, so far, sitting at 20.12% now, and, we've had relative currency stability, with the Naira even, getting below the 1.5 level, So we've been enjoying this stability for a while now. Even when you get to the food market, there's also, stability. You can plan, your business around what's playing out with the Naira, right now. But is this enough for a rate cut at this time in Nigeria, or we should give it more time? And how much time is enough?
Another fantastic question, Laddie. So, in my view, I believe it is important to give it more time, because the reality is we had a statistical rebasing which brought inflation dramatically to what it is today. And of course, the MPC supported this drive by hiking up rates to, if you will, deter businesses from taking loans at any price point. So overall, what we see is that it's important for the MPC at this point to still hold. It might seem like a counterintuitive, or if you will, a contrarian view, but I think holding might be a more conservative approach to take, just to ensure that the rates continue to go down. Because if you remember now, we are in harvest season. So depending on what part of the country you find yourself, A harvest season is from late August to September, all the way through about January, thereabout. But right now, if you go to the market and ask households, ask MSMEs, ask traders, how much is a tuber of yam? You see the prices haven't really dramatically declined, as it were. However, I suspect prices may continue to come downwards because, especially food inflation, because we're in harvest season. Again, it's also important to take a look at what tends to happen with post-harvest loss because of insecurity and so on. But that's a fiscal issue. So when we consider the fiscal landscape, has the administration done enough to curtail, to curb down the insecurity? I think the answer is yet to be determined because it's all predicated on the outcome of harvest season. If post-harvest losses decline a bit, if people generally feel more comfortable, more secure, it all boils down to how you truly feel. Does your money take you as far as it needs to go? The answer will tell you right there. Most households will say prices are still relatively high. Notwithstanding, I still believe that the MPC will have to be very conscientious, deliberate in the decision they take because it has far-reaching implications. While I know to cut because the global trend is to cut to stimulate growth, the question really is the growth path we're on today, even with a rate cut, would it stimulate more growth between now and end of the year to get to a 4.5% GDP growth rate? I don't think so. So, in my mind, if price stability still remains the core mandate, among other ancillary objectives of the central bank, I would say perhaps it's apropos to just essentially hold for now. Maybe in the next meeting, depending on the pathway of inflation, if inflation continues to take a downward pathway, then maybe in the next meeting, it's high time we now cut to stimulate more growth to feature into next fiscal year.
So that means at this point, a hike is out of the question.
Absolutely.
All right. So if we see a cut,
absolutely.
If we see a cut in this meeting, what's going to happen? What do you think will happen in the short term to the Nigerian economy if we see a cut tomorrow?
Okay, if we see a cut, is depending on the size of the cut. So
let's say 25, let's say 25, 50 basis points.
Is mere signaling to the market that more cuts are coming down the line and we're trying to stimulate aggregate demand, make it easier for borrowing costs to come down, and so on. So that's important too. I'm not taking my eye off the ball there, but all I'm simply saying here is you run the risk of cutting too soon, only to exacerbate inflation, in which you've been doing a fantastic job in curtailing so far. So, by and large, I would say if you cut now 25 to 50 basis points, it's inconsequential, immaterial. There will be no relative movement in terms of aggregate demand. However, if it's a much larger cut, say 100 basis points and so on, then you might see some degree of aggregate demand, more borrowing, more lending to SMEs, and so on. But as it is today, 25, 50 basis points is what most analysts have opined. I'm of the view it's important for the MPC to hold. That way we get better visibility as to how it's playing out in terms of harvest of the crops, because food inflation is a major driver here. So I think it's important to take a more conservative stance to allow the numbers play out over the next couple of months, because I know the MPC has another meeting before the year runs out. So that could be an opportunity to reassess and perhaps now cut. But for now, my money is on it's important to take a conservative approach.
Right, and definitely we've heard the manufacturers, organized pirate sector, they've been calling for a cut for the longest time when it comes to interest rates. But let's look at the foreign side of things now. What impact could a hold outcome or a cut have an investor sentiment, and that's foreign investor sentiment and capital inflows?
So a hold will signal that we are still considering the under fundamentals within the economy. Like I earlier said, fiscal monetary policy have to continue to better coordinate themselves. So for investors meaning FPI, they're looking for a stable climate, which we kind of see ourselves right now in, but with higher returns. That's what's attractive for FPI. But what we haven't done so well is FDI, that's foreign direct investments. And that aspect of our lever needs to be actually pulled. And to achieve that, we have to demonstrate as a country some deliberate steps in ensuring that the industries that these FDIs want to come in are stable, the policies there are visible, the way and manner in which frameworks are developed and implemented is key. That way they see visibility, I can bring my money into the country, keep it here for 5 years or so, because we need cool money. FPI remains hot money, but technically, if hot money keeps turned around several times, it can become cool money depending on the stability of the economy. Right now, as it is, the economy arguably from a statistical perspective is stable. GDP 3%, 3.4, 3.5% or so. That's good. Inflation is statistically coming down. That's good. So on paper, face value, I would say that the economy is churning along well. However, those folks at the bottom of the pyramid, households, MSMEs, are still feeling a bit of a pinch because of high borrowing costs, which a cut will support that narrative. But again, it's a delicate balance, because if you cut too soon, you suffer a liquidity overhang. If you recall at the top of the hour, I mentioned the allocation, FAC allocation. That number, that level of liquidity has risen over the years now. I remember counting when it was around 1 trillion, 1.2 trillion, 1.5 trillion. Now we're at 2.2 trillion. That's a lot of liquidity that goes into the economy. Talk less of other aspects of the economy that needs to spur economic growth, whether it's in the financial services sector, a real economy such as manufacturing, light manufacturing, agriculture, for smallholder farmers especially, and so on and so forth. But the truth here is, at a macro level, the central bank looks more than just the exogenous variables coming, what's happening outside of the economy. What we can control internally too is crucial. That's why the fiscal policy side, fiscal arm, and monetary arm continue to work together to cure some of these things. So food inflation, which we've talked about already, which is a major driver, we will begin to see it come down simply because we're in harvest season. But if there's still insecurity, which I hope there isn't, we'll see the numbers at the end of the day. The idea here is, at the next meeting is when I believe a cut will be more useful, because in that regard now, the timing will be spot on. But your guess, ladies, is as good as mine right now. The conversations are ongoing, but I suspect that the central bank governor, he has gone on different speaking engagements, and in my mind, the language he's used, he's signaling a cut is imminent, which, again, the MPC will ultimately decide that. But in my mind, it's key to hold right now, simply because we need to see inflation levels come down further and make sure it is real inflation coming down and not just statistical. Exactly.
We need to feel it, when we go to the stores and the markets, and actually feel that inflation has come down when I'm spending, out there. But do you see better coordination between the monetary and fiscal policy side? Do you see that emerging, or are they still pulling in different directions?
Well, I think there's a lot of work has been done actually in terms of fiscal monetary policy coordination. That's the simple truth. You see the fiscal policies coming up, different frameworks and different sectors. For example, there's this industrial policy that's coming online shortly through the Federal Ministry of Industry, Trade, and Investment. That's very useful because Nigeria requires an up-to-date, a long-term plan for industrial policy. That's fine. We've seen the Minister of Finance and the Governor of Central Bank go to different forums to ensure that they're speaking in similar voice, which is also key. However, implementation is where the rubber really meets the road. So if we have a situation where FAC allocation has grown this much, which from every indication seems like a very good thing. However, that needs to translate to real inclusive growth. And in my mind, and what we have observed in the real economy, we're seeing a bit of a degree of sluggishness from some of the MSMEs we speak to. Notwithstanding, on the fiscal side, though, those at the bottom of the pyramid, the fiscal side has done a good job in capturing those folks and giving them the safety net tools, these automatic transfers to support their businesses and just to support their livelihood. I've read in a few papers where the Minister of Finance received 3 payments. At least see some traction of the coordination. And this is a journey. It's not a one meeting or 2 meetings. It's a continuum. And this has to be deliberate and it has to be reinforced by anybody who sits in those seats.
All right, definitely so much to unpack there. Decision day, we'll get it tomorrow. We see Professor Joseph there calling for a hold again at this point. That's almost like a do nothing, while we see private sector calling for a cut. Well, we'll wait and see. Tomorrow we'll get that decision. Thank you so much for breaking it down for us, Professor Joseph Nnanna, as the Chief Economist, Development Bank of Nigeria. Thank you for coming on the show today.
Thank you for having me, Laddie.